All right. Well, why don't we go ahead and get started? If you have any problems hearing me or anything like that, just let me know. I'm sure I can make some adjustments. So let me make an introduction while I open up my presentation. And for those of you who don't know me, my name is John Jagerson, and I'm one of the principals over at pfxglobal.com. Yeah, it has been a while, CVJ. It's good to see everybody here actually. So I'm excited to chat with you for a little bit. This is kind of a different presentation. Forex versus futures. I'm not really going to be talking about strategies as much as I'm going to be talking about the two markets. And there's a reason why. There's a reason why I feel like this is a very worthwhile discussion. The number one, I think Forex traders and practitioners should always be aware of what's available out there. There is a lot of misinformation about both the Forex, as we probably all know, and futures. And a lot of this is perpetrated because it's competitive issues, and so there's a fair amount of misinformation out there being used as marketing information to prove that a spot dealer is better than trading with a futures broker. When I think I can show that they're very equivalent and they have relative benefits and advantages. So that there are some clear differences, and those differences do account for some of the benefits and disadvantages. But and part of the reason why, additionally, that I would use to preface this discussion a little bit, uh, uh, part of the reason why I think this is such an important discussion is because of developments that are going on in the futures market and in the Forex. So, over the last few months, we've been seeing Forex dealers, a few of the big ones, beginning to offer futures contracts. And I'm not talking about spot metal contracts, I'm talking about actual futures contracts being traded electronically on futures exchanges around the world. And we're seeing the futures markets trying to get into the spot Forex market. So we're seeing this convergence, and I think over the next 18 months or so, we're going to see some some very exciting stuff, innovations coming out from both sides of that market as they compete with each other for our business. So I think that this is a worthwhile discussion for us to have and to understand that there are opportunities out there as a trader that you may want to take advantage of. Additionally, the last thing I would say to preface this is that one thing I always tell traders, we for I'm sure most of us here would fall into this category. We all remember, some of the big dealers that have had financial trouble or gone out of business over the last few years. And there was one in particular, Refco. I'm sure everybody remembers that, where it just happened suddenly. There were a lot of traders caught up in that situation with locked accounts, and since then the settlement has been very negative. And so I talk to traders all the time who are very skittish about dealers and brokers in general, as to how likely is it that this same thing that happened to Refco will happen to them. And so one of the things I talk about all the time, besides diversifying as a strategy to use in your trading, but is diversification of your accounts. So it's really something that I look at as there's nothing wrong with having multiple accounts. I certainly do. And sometimes I have those accounts with a particular dealer or a broker where I'm dealing with futures for a specific reason. So in the case of the futures market, there are some very specific reasons that I have a futures account as well as spot accounts. But one of those reasons is just that I want to keep my accounts diversified. So if if one of these big dealers again has problems, I can respond to that. I don't go under with them. So maybe I get hurt, but I don't get hurt as much. I realize that happening actually happens very, very rarely, but when it does, it's catastrophic, right? So it's just more of I'm a big believer that forex traders should be in control of what's going on around them, and they should definitely be aware of what's happening around them. Okay, well, why don't we get started here? I'm switching my slide, so you should be seeing a slide that says futures background, and I just want to talk a little bit about this. I realize that some people out there have traded futures in the past, but I know a lot haven't, and in fact, I'm surprised actually at how many Forex traders. I would say the vast majority have never traded futures, and so they may not know how similar they are, and a couple of the subtle differences. So let me explain briefly what some of these differences are, so that we can really do a good comparison of futures versus the spot Forex market. So number one, it works like spot for buying and selling. It's the same thing. So if you're buying the euro US dollar in the futures market, it's really the same thing as buying the euro US dollar in the spot market. Now the contract sizes and things like that are subtly different, and I'll show you a couple of examples here in a minute, but not materially so that you'd worry about it if you're trading full size lots. Probably the biggest issue is expiration. This is one that freaks people out a little bit, but you don't need to be. It's not really a big deal. Here's what happens when you're wanting to buy a contract on the euro. Let's say you're trying to buy the euro dollar in the futures market. Well, they have 6-month expirations on those contracts, which means that, and they basically expire on a quarterly basis, so March, June, September. So, for example, right now, you could buy a euro dollar contract. I shouldn't say that because that's a separate futures contract. You could buy a euro US dollar FX contract that expires in March, about the middle of March, or about the middle of June. September is not available yet. So the only way the only thing that really does to impact you as a trader is that it says, well, if I buy it today and I plan on buying and holding this position for a very long time, and I buy the June expiration, well, I probably better sell that contract and buy one with a longer expiration. With the longer expiration before expiration takes place. So it's not really a big deal. I mean, we're talking 4 times a year. And in most cases, most futures traders or most Forex traders that I know are not trading things where they're out looking out, a year at a time. I mean, there's some. I know a lot of carry traders myself. We may hold positions for longer than a year, but it would be pretty rare. So as far as short-term traders, it really turns into a non-issue. So I'm getting a couple of questions about whether you can see a futures contract, and I actually have a couple of examples I want to show you here in just a minute. And then the second question was, what is the advantage of cost differences between option and futures option versus spot? Well, so let me get back to your question about futures options, because that's a kind of a different animal. So we're talking calls and puts there. So let me pause on that question, and let's see if I have time to come back to it. Or, if we aren't able to come back and really do a comparison of futures options versus spot, then you can send me an email. I'd be happy to chat with you about it. But if what you mean is not futures options, but just futures versus spot and the cost differences between the two, I'm going to get to that here in just a second, actually. So third thing, futures are traded on an exchange, and in this case, usually we're talking about the CME, the Chicago Mercantile Exchange, where the currency futures were first started being traded years ago, and they're always U.S. dollar quoted, which is kind of interesting actually. When you so sometimes it's inverted from the way spot traders are used to seeing it, and I'm going to show you a chart of the futures contract on the yen dollar because it's a little bit weird, and it throws people off a little bit at first to see it completely inverse from the way they're used to it in the spot. But otherwise, the euro dollar, the pound dollar, etc., are all the same. Now, one of the big advantages, though, that I would point out before we even get to cost is transparency and regulation. So I get into debates with people all the time about what the interbank market actually is and what it isn't. And one of the things that it isn't is it's not an exchange. It's kind of a network of a whole bunch of banks and such, and they're looking at each other's dealing books and stuff. But it's not the same thing as the same kind of centralization that you get from an exchange. The advantage that you get with that, now there's nothing wrong with the interbank market, and there's definitely nothing wrong with spot. It's just the advantage that you get with the futures market is you have access to a deeper pool of information. So as a spot trader, what you have access to is the filter from your dealer, whether that means that you're working with a dealing desk at your dealer or whether they're passing it through to another dealing desk in the interbank. It really doesn't matter. You're seeing it through their filter. So even if they're showing you multiple dealing desks in the interbank, it's still through their filter. They can't show you every interbank participant. But what you can see in the futures market is you can see order size. You can see what the inside quote looks like, how big that is. And I'll show you an example here in just a minute. So let me talk about brokers and commission. In the futures market, the equivalent of your dealer is your futures broker. And they are the ones who are basically clearing your trades for you. They're executing your trades for you on the exchange. And in this case, the brokers are going to charge you a commission. Now, dealers don't charge you a commission, but in reality, they do. And so what I would do is, what I would take into account is as we go through this, I'm going to show you a couple of examples of trading costs. So in the spot Forex, we know that there's really one primary trading cost, and that's the spread, the difference between the bid and the ask. And there is a spread, a difference between the bid and the ask in the futures market as well. So what you'll find is that most futures brokers, if you're dealing with spot FX, if you're working with a good dealer or a good broker rather, they're going to charge you a commission per trade. If it's round trip, meaning both you sold it and then you bought it back, or you bought it and then you sold it again, so you opened and then closed the position, your total commission is going to be around between $6 to $7, and per contract. So the one way you could look at that is that, and if you were to really actually make it an equivalent to this underlying the notional value, it's about 0.6 of a pip. So what you want to ask yourself is, well, okay, that doesn't seem unreasonable, but is the spread in the spot FX narrow enough to that I'm actually saving money by trading in the spot? And what you'll find is they're roughly equivalent. So the spread in the futures market is typically narrower on average. And you can get these averages, by the way, from Forex dealers. You can ask them what their average spread is, and they'll generally tell you if you ask. And if you just empirically go in and take a sample of the spread that in the futures contracts, you'll find that it was a little bit narrower. If you add that commission, you're talking roughly the same trading costs, maybe a little bit cheaper in the futures market. The reason why I would say that is for those of you who are dealing with are working with dealers who have a like a no dealing desk option or something like that, where they don't have a fixed spread, so the spread may shrink quite narrow. I've seen one good dealer who's been doing that for a long time. They have an average spread on the euro dollar of 0.9 pips, so just barely under 1 pip, which is really actually very competitive. But one of the problems that I hear Forex traders talking about all the time is what happens when the market gets real crazy and that spread gets real wide. So I just got a question as to who that is. So here's what I would ask: send me an email and I'll let you know. I don't want to interfere with advertising. So which, by the way, you're perfectly welcome to send me emails if you want clarifications on any of the things that I was talking about or more information about whatever. So don't hesitate to send me an email. So the comment that I hear all the time from traders is that it was great to get a real narrow spread, but then when periods of market illiquidity come, the spread gets really wide, and this is where you'll see the biggest difference between the dealers and the futures market. Is that while the spread will get wide in the futures market, it doesn't get anywhere even close to as wide as you will see from some dealers. I've seen spreads on the euro dollar get to 25 pips wide here this year already. with dealers for a little while, not for a whole day, but for 15, 20 minutes, half an hour, and that can be very troubling to a lot of short-term traders, I know. Okay, one of the other things that I wanted to clarify is, which is, in the futures market, because of that transparency, things are very competitive, and which is I'm a big believer in the way that competition initiates innovation. So that's one of the reasons why I'm so interested in the futures market, because while they may have gotten caught by surprise at what spot was able to do with attracting all of us retail traders, they won't let that happen for very long. So it's well worth our time and effort to understand that market a little bit, because the innovations that they'll come out with to try to compete with spot will be quite exciting, and we're already seeing some really exciting stuff. So product line, this is another question that I get all the time. Most dealers have between 20 to 120 different pairs. In the 120 different pairs, usually what I see is just permutations of an infinite number of crosses with really wide spreads. So we kind of have to discount that a little bit. I would say there's probably 20 to maybe 50 usable pairs that a particular dealer may offer. And the futures market is very similar, with a couple of differences. There's really 20 majors, and you will see 20 crosses, or so. There's give or take, but they include some interesting ones. So, for example, there's the U.S. dollar index itself. That's not necessarily crossed with anything. It's crossed with a basket of currencies. So whenever you hear about analysts talking about the U.S. dollars index, well, that's a futures contract. You can trade it. The Brazilian real, I think this is really the carry trade of the future, by the way, but we'll see. But I don't see hardly any dealers offering that. In fact, I only know of one. The Chinese yuan, the Israeli shekel, the Korean won, even the Russian ruble. So a lot of these are not available from Forex dealers, but they are available on the futures market. So again, one of these reasons to not necessarily give up your Forex accounts, but maybe diversify into a futures account as well. Not to mention the fact that when you're dealing with a futures account, you have access to other futures markets such as energy, metals, etc., which may be more convenient than trying to find a currency proxy for that. So here's what I'm going to be talking about. I want to go to the charts just so I can kind of show people who have not seen this before what these charts look like, how similar they are, what does the spread actually look like, etc. We'll be talking about the spread, commissions, interest. Is there 24-hour trading in both markets, transparency, flexibility, and I have a couple of examples to show you for each of those. And then I want to get into the last thing I wanted to talk about was rollover, because this is actually one of the big differences between the futures market versus the Forex it can be a big benefit to traders. So I'm going to stop sharing here. I'm going to bring up my charts. Hang on just a minute. I'm going to show you a couple of things. Okay, so I mentioned, by the way, that you can trade the Russian ruble. So here's a chart of the Russian ruble. As you can tell, it's not very actively traded, but this was a pretty sweet little double top formation here that broke down recently. So there are accounts, or there are futures contracts available in markets that you may be interested in, but which you don't have access to currently. And in particular, I know there's a lot of long-term traders who are very interested in the Chinese currency right now. So for obvious reasons, and that's one that's available in the futures market, and not widely available in the spot market. Now, one thing that I also wanted to show you, do a little follow-up on. This is the Japanese yen futures contract, and I just wanted you to take a peek at the quote here, 93.44. So actually, if you were to imagine that it's actually 0.009344, that's the yen dollar quote. So that's how many dollars it costs to buy a yen, is 0.009345. So not too confusing once you've kind of seen it. In fact, if you look at the price pattern here, and then we'll pull up the actual spot contract, and there's the spot contract. It's just the inverse. except here, we recognize the quote 107.01. Now, there are tools, by the way, if you're interested in being able to trade, but that seems really confusing to you. I wouldn't worry too much about it because there are some great tools provided that you can figure out the inverse really easy. And so if you're trading both the spot and and in the futures market, there's some great free tools. I'll show you how to get one of them where you can convert your futures contract into its spot equivalent very easy, so you can tell the difference, particularly if you're looking at something that's inverted like that. So what I wanted to do was illustrate a couple of things. I don't have a lot of time today, so I wanted to be able to just show you a few things and then maybe spark a conversation from that, and hopefully get you to investigate some of this on your own. So I'm going to stop sharing my charts for just a minute, and I wanted to show you something else that I had mentioned, but just make the point. Now, what I'm bringing up right now, I'm going to share my my futures broker, by the way, can't always shows my account number, so I actually got a demo account from them to be able to show you this morning. But these are live futures prices. So I've got the euro here in my quote board. This is going to be a format that most of you will probably recognize. I've got the euro up here. This is the euro futures contract, the March expiration, and you can see the spread, so 39 to 40. So it's a 1 pip spread. And by the way, you can pull random samples at pretty much any time in the day or night, and coming in between that spread is pretty simple. So it's not it's not too complicated. Boyke, to answer your question about what happens if you hold after the expiry date, you're responsible for delivery. However, your brokers are very helpful in making sure that doesn't happen to you. I haven't talked to a trader for years who's had delivery happen to them. Okay, I'm going to stop sharing this, and I want to show you something else that you can see on your own. Okay, this is a handy little tool developed by the CME, and so for those of you who would like to be able to bookmark this page on your own, it's kind of an interesting tool to be able to see what the and what I wanted to do was illustrate the transparency in the market. So this is a free tool you can go see at any time. It's live. And it shows you what kind of size is lined up behind your trades. So, for example, we got the futures bid and the ask prices here, and then how big those positions are lined up behind it. So there's 27 contracts right now in the inside, the bid portion of the inside quote. And of course, these are changing all the time, but it gives you a bit of an idea as to where traders are lined up. And for those of you who are used to who have any experience using level 2 quotes with ECNs in the stock market, it's a similar concept in many ways, except it doesn't tell you who it is. But it does give you an idea as to what's going on and how big is that's going on. And you're talking about a market, by the way, just to give you some perspective here. The difference between the futures market versus a spot dealer is that you're going to be able to see traffic that's basically, it's about $85 billion a day. Your biggest Forex dealer has transaction value of about $11 billion a day. That's the biggest, and then there's a huge gap before you get down to the bulk of most Forex dealers. Now, that does not mean that the interbank market isn't huge. It just means that's what they're trading. So you kind of always have to keep that in mind as you're dealing with their filter. Also, you'll notice they're converting. So the middle section here in this little order book that we're able to see is the Japanese yen. They're converted. They'll show you what the equivalent is in the spot market instead of having to see the unusual quotes that we're not used to, the 93.52, 107.10. So you can kind of tell what that is. All right, so let me stop sharing that for a second. All right, so there was an important discussion that I wanted to be able to have about rollover, because this is one of those discussions I think that traders should be extremely concerned about. Rollover is something that I don't see enough dealers competing on, and however some will, and it's it's a if you're not getting paid your the proper amount of rollover, it's because your dealer is keeping it. So anyway, rollover, that interest payment tomorrow, next, whatever it is that your dealer calls it, is a payment, or they'll adjust your position favorable or unfavorable depending on what side of the transaction that you're on. So, for example, if you were long the pound dollar or the Aussie dollar or something like that, you're going to get paid this little premium every day as long as you're not using an insane amount of leverage. And that's either they're going to do that in a tomorrow next policy where they adjust your position, or they're going to make a payment into your account. Well, in the futures market, it's intrinsic in the price. So what that means is it's kind of wrapped into the price. There is, by the way, there are brokers who don't pay you rollover. So I saw a question. There are brokers who don't pay you, but as far as I know, or dealers, but as far as I know, everybody charges. So I think there may be some special accounts that may be an exception to that rule, but the large brokers, that's what they do. So, but what do I mean by intrinsic? So here's what that means, and let's use the Aussie as our example. I'm going to go back to my charts for just a minute. And on my charts, I have two contracts. I have the Aussie spot contract, the Aussie dollar spot contract, and you'll notice that right now that spot contract is at 92.30. Okay, and so I'm going to minimize that, and then I'm going to bring up the futures contract for the same thing. This is the Aussie dollar again, except this time I have a price of 92.10. This contract, by the way, expires next month. Here's the difference. You'll notice that these are that the spot contract is higher than the futures contract. And the way that this works is, let's imagine that prices were to freeze, that the Aussie and the dollar somehow got pegged to each other and they didn't move at all. Well, what would happen is, so I'm drawing a line at where that close price is, and then I'm drawing another line at 92.30 right up here where the spot price is. So what would happen is that this futures contract every day would grow just a little bit until at expiration, which is about the 16th of March, you would get you'd have prices that were equal to each other. So your futures value grows intrinsically in the same way, and actually when you break it down on a value basis, so if you convert that into a daily dollar value versus a daily dollar value that you get from your dealer, I do surveys on this all the time as to who's paying the most rollover and dealer-wise, and the futures market always beats them by a lot, which matters to, so in fact, last night, for example, I ran one, and I found an average difference of, let me see, I made a note of this, 30%. So 30% better premium being more or less paid intrinsically in the futures price. And that's because there isn't a middleman in the same way. There isn't a middleman trying to clip part of that premium. Well, I've run out of time, but I covered the most important things that I wanted to be able to chat with you about. So let me point you to a couple of more resources if you would like to have a little bit more detail. You're welcome to contact me at john@pfxglobal.com. And I've actually written a couple of articles and done some presentations on this very thing before. Also, this is being recorded right now and will be available to you from FX Street on their site. And I generally finish those recordings and send them up to them within a day or two, so you can review that. If you'd like to have a copy of the presentation as well, you're welcome to email me and I'd send it to you. So thanks, everybody, and I hope you have a great Friday trading and a great weekend.